But the market we're starting with Obianuju Nsofor, who is one of the investment analysts at Afrinvest, is the fixed income. A very decent January for the debt management office, rolling out about 250 billion in the first auction in the new year. That's a very nice way to start the new debt office calendar for 2018. Obianuju, good morning. It's good to have you here.
Good morning, boss.
That was a good one last week, isn't it?
Yes, it was.
Yes, a very decent way to get the new year started. Yeah. So where do we find the yield curve on this particular auction that we flagged off in 2018?
Well, in a years, as of 2016, we saw like an inverted yield curve. I mean, investors sort of paid attention towards the short-term end of the yield curve. But what we've seen as of late last year is that there's been a flattening of the yield curve. So, I mean, this is all attributed to the ongoing activities in the fixed income space. The federal government is sort of leveraging on single-digit borrowing in the foreign space rather than opt for double digits for the local investors. So they've actually stopped the longer tenor instruments for bonds as well as the OMO instruments, and sort of reduced treasury bills auctions.
Yes, but again, if you look at what the debt office raised last week, 215 thereabout, that's quite significant above what it is expectation was, despite the fact that the yields for FGN bonds is shrinking, and we've seen that bond yields around plus or minus 350 basis points over the last 1 year.
Well, definitely. Before I talk about that, I think it's pertinent to look at the treasury bills auction that was held in the previous week. So we saw the 91-day, the 182 and the 364-day instrument just barely allotted about 100 billion naira. So this unmet demand actually trickled down to the domestic bonds market, and that was why you saw the oversubscription for the 5-year and the 10-year bonds that were issued last week.
By the DMO. So, yeah. So it's a bit of investors are looking at the central bank and they're looking at the DMO and asking themselves, where do I, quote unquote, game this market if you see yields squeezing somewhere for short-dated instruments. All this is looking really good. But again, if that means that investors are looking at something else. That's just equities now.
Well, there are actually two markets they can play in, the fixed income market and the equities market. I mean, given the fact that yields have actually moderated in the fixed income market, they are still relatively high. I mean, at 14%, 13%, it's still attractive to these investors. So investors have this opportunity right now to play in both segments of the market. As of this year, the equities market has done remarkably well, although we saw sell-offs as of last week. I mean, we saw three weeks of bullish run, and it was only, although fundamentals are still right, it was only right that investors sort of take profits as of last week. So we saw out of the 5 trading sessions, the market actually closed lower on 4 of this session. But then again, if you look at Fridays on a technical basis, the RSI was about 67 points, which is close to the overbought region. So as this week commences, we also expect to see some profit taking in some of these stocks. But then again, full year 2017 results are going to trickle in as late as February, early March. Early bird investors are still more likely to take position, given the quarterly results that we've seen last year were largely positive.
Are we still looking at a bit more of dynamics here play out in the equities market, even with the debt? With the debt market. If you look at the lower funding target for the government this year, when it comes to domestic borrowing via the debt market, do you think this gives the equity side a lot of headroom to grow with or without the full year and the quarterly earnings?
Well, definitely what is actually driving the equities market now is a number of factors. You look at oil prices, I mean, they've sort of reached about $70 to a barrel. Our macroeconomic landscape has improved. The I&E window has remained stable since the launch in April 2017. So these are the factors actually driving the equities market. More so due to the improvements we saw at the FX market, we've seen companies' results actually post positive margins, and this has sort of boosted profitability. So you see that investors are still keen on investing in the equities market.
The equities market will always be a good one. I like there's still a decent rally we have. We're still about almost 14.5%.
Yeah, year to date, we're still about 14.5%, although we've seen the market sort of correct as of last week. I mean, but towards the end of this week, we also hope to see buy sentiment from investors.
Yes, buy sentiment. When the numbers for last week came in, and you see that despite the profit booking, in terms of the primary market indicators, in terms of the volume of shares traded, in terms of transactions on a daily basis, it looks like this buying appetite is still there. And the news is just coming in this morning that Nigerian Brew is listing an additional close to 70 billion ordinary shares on the market. And you look at the volume of Nigerian breweries over the last couple of weeks, just massive on a daily basis.
Yeah, you see, the rally actually encompassed both small, medium, and large cap stocks, so that no stock, or rather, was actually left out. So although the profit taking we saw was largely due to the small cap stocks, we saw the likes of Skybank, Fidelity, Unity Bank. I mean, they actually moved in prior weeks. So we saw investors actually sell off on the stocks.
Yes, and is that preparing everybody for the new par value?
Yes, yes, and that was also what drove sentiment last week. So you see that stocks that are trading at about 50 kobo, they sort of sold down on it in order to wait and see how this par value is actually going to affect.
The regime is going to work out. Yeah. It's going to be a very interesting regime. What's your thought about it?
Well, it's actually welcome. Anything that sort of brings about market realities, demand and supply, it's actually welcome. So we can truly see stocks that we can actually see the true pricing of some of these stocks that have been hiding between that par value, the 50 kobo benchmark.
Yeah. But we always believe that they should trade below 50. So they'll be hiding around 50 kobo per share. And I can list names. I'm sure a number of banks, a few banks.
Yeah, a few banks.
Yes, we're hiding around that 50 kobo.
Insurance stocks, I mean, they're also there too.
But the stock exchange says the idea is to improve liquidity and all that. Do you think this new par value, new pricing methodology in terms of the volume of what you need to make price, either up and down on any of these stocks, would go to the local retail investors who are holding some of these shares? Do you think they will be forced, or they will be incentivized to come up and say, look, I can sell this off below this level, or I can buy more of this level because I just believe in it?
Well, it actually goes two ways. So you see that investors have actually held some of these moribund stocks, I mean, at 50 kobo. They could actually want to sell below 50 kobo, but due to the fact that there's no demand for these stocks.
If someone is willing to pick it at 40 kobo,
I mean, I would just let it go. I mean, and try and recoup my lot. Seizing another stock or thereabouts. So yes, it will definitely improve liquidity in the market.
Yes, but it's still early days yet to find out how this is really work out, because the stock exchange says it plans to create another Group C and going to reclassify companies listed there based on their prices. This is something entirely new. It's a blue ocean for me. There's a lot of learning curve. I think we just need to get back some days in the head and try to see what more we're learning from the stock exchange and explaining the entire new power value thing. Thank you very much, Obianuju. Do have a great week ahead. One of the investment research analysts at Afrinvest. Still